Good afternoon, everybody. It's Tuesday afternoon in Houston, spring break in Texas, and we've got something really exciting for you. If you are working away, you're going to love this. If you're on the beach, we're hoping you enjoy it even more. We'll give you some things to think about. We've got our usual cast of characters, Mike Bradley, Colin Fenton, and Matt Portillo, and we've added in some real spice to today's discussion. From the home team, we've got Kirk Chatawanich, Erica Powell, and EJ Snickeris. These guys are from our Subsurface team, and they're going to answer a very difficult question. What are the 5 most important things happening in the subsurface in the lower 48 of the United States in today's world? And one of them is a alternative energy, new world kind of thing. So stay tuned for that. But before we get to that excitement, we've got a fantastic guest with us. We've got Dr. Atul Arya. He's from IHS Markit. He was a 20-year veteran of BP that has been at IHS Markit for 10 years, and he is fresh from helping Jamie and Dan and the team at CERA plan CERAWeek. And if you didn't tune into CERAWeek week before last, I think it was one of the biggest and one of the best. I'm biased, but I know all of us at TPH had a great time watching many of the segments, and Atul is going to give us a behind-the-scenes what really took place, what did he think, type analysis. So Atul, welcome. It's so great to have you, sir.
Well, thank you for inviting me, Maynard. It's a real honor to be with you and the colleagues here. Well,
it's a lot of fun, and we're excited to have you as part of the family today and more broadly. Let's just jump in real quick before we hit the main attractions. Mike Bradley, what's happening on that screen today? It's spring break. It seems like we ought to get a lot of green for spring break.
Yeah, Maynard. As you know, we've been really optimistic energy, year to date, and really for the last 4 or 5 months. And it's just because the fundamentals have been getting better. Money flows were moving into the group. Macro money was moving in for an inflationary trade. And guess what? This starting this week, we kind of hit a wall. I mean, like you said, you got a lot of people on spring break. You're seeing volumes are down 40, 50, 60% in some of these names. The crude oil tape has kind of gone sideways here. And so I think it's really a group where it has been, technically overbought. We've been telling you about that. But we think a pullback is going to be healthy, and that's what we're experiencing right now. One of the things we've seen here in the last week or so is we've seen some energy companies hitting the market with secondaries. And so you've got a market right now where that's going to happen. There's going to have to be some consolidation, and that's a good thing. We need consolidation because long onlys do not want to be chasing this group. If we get a little bit of a pullback like we're having right now, they're going to feel a lot better about putting monies into this market. And so this is a pretty healthy thing that's going on. It doesn't feel good right now, but it's a very healthy thing to encourage longer term investors to come in for the balance of the year.
So my quick question, plus or minus, based on your recollection, the new issues this year or the secondary sales, the issuance of stock this year, are investors, generally speaking, doing pretty well in those investments?
Yeah, for sure. Because you've been in a big uptape. I mean, there was a company a couple of weeks ago, like in Magnolia, they went out and priced something. It was deep in the hole, but it recovered up 25 or 30%. So yeah, it looks like right now, if you come to market, you're going to get discounted, probably anywhere from 8, 10, 11%. And then if you have the tape behind you, which we have had, you've done well. And so we think we're going to see more secondaries come, and I think we're going to be okay because I think long only money wants to come here. They're feeling very good about what these companies are saying, pretty much a, free cash flow, return of capital, and that's resonating very, very well. And so we just need to have, things clear up a little bit here. And I think that's what's going on right now. This is a consolidation phase. It never really feels good while you're going through it, but it's setting up the next move, and the next move is not going to be lower. It's going to be higher.
See, Matt, as we turn to you, consolidation is like one of those words like terminal value. Like, it's one word and there's 8 different uses of the word. But Matt, how are you feeling about investor sentiment, stocks? I know you're working on a new report.
Yeah, no, I think Mike hit it right on the head. And we talked a bit about this last week, and we kind of tend to cover it on a weekly basis, but what the stocks are generally discounting. And one of the things we kind of ran into as kind of momentum really picked up here over the last few weeks was that, and looking at the upstream space as just a placeholder for this conversation, equity started to discount, effectively strip pricing, which at the back end of the curve was getting you into that kind of $50 to $55 commodity price environment. And I generally think that today is where most investors kind of shake out on their long-term price deck. Now, again, if we see less growth out of the U.S., if we see greater capital discipline, then I think over time, the front end of the curve is going to merge into the back end of the curve, and we'll continue to see upward bias. And ultimately, as those cash flows get paid out, then the equities can march higher. But I think, this pullback, as Mike mentioned, is healthy. Clients had kind of paused. We've seen a drop off in volumes across the sector. And I think as we start to consolidate here, as he pointed out, and as we kind of march into Q2 and continue to hear the industry hold the line on the capital discipline side of things should be okay for the sector, broadly speaking.
I mean, isn't it honestly kind of a nice thing to hold where we are right here around oil price and let the companies do their work and show their discipline? And I mean, it's not all bad, because I think people were starting to worry we were getting ahead of ourselves, honestly. So I don't know. I see you guys nodding. Maybe you kind of sort of agree with that. Now, Matt, you do have to tell us, you just launched on something today, so you got to tell the world what happened there.
Yeah, Jordan McNiven, you've seen on Close of Business a couple times, who's also co-heading our global power team, actually came out with a hydrogen report. So just for some context, last year he and his team put out a very well-received global power piece that kind of touched on everything from solar to wind and our broader views around how that fits into the power complex. Then the upstream team, which is also picking up autos, recently put out an 85-page deck on the automotive industry and walk through our broader macro views. And now we're starting to wrap up the broader macro pieces, and we'll start to get into micro-specific conversations here in the not-too-distant future, but put out a piece on hydrogen and how we think about the market evolution. Today, I think the takeaway is we do see a lot of growth in green hydrogen, but the cost structure as it stands is not necessarily competitive at the moment. So there needs to be a lot of progress on the technology front, especially electrolyzer costs, and seeing those come down. So we're quite optimistic, I think, over the medium to long term, and we've obviously seen what's happened in solar and wind. But I think in the near term, it's really going to be about building out that business and really recognizing where the market's potentially headed over the next decade or so. So for those that are interested in the piece, feel free to reach out to your TPH representative, and we can get that over to you.
It's funny. Every time you send this, I get these messages from friends who say, "I'm guessing you're my TPH representative." I don't know, but no, that's really exciting. Congrats to you and your team for getting that out. That's landmark stuff. Colin Finn, what do you make of today's world? And we know you're gonna throw something spicy in the soup here, so let it rip.
Well, picking up on those two prior comments. What we're seeing also is the fading of the winter demand effect. And we've been talking about this since the winter storm Uri hit the mid-continent in February. The underlying condition of demand has not been as strong as might be surmised by price alone. And remember, this is precisely why on March 4th, OPEC Plus opted to extend the supply cuts. And I think that we're seeing now that decision was rooted in empirical fact. Now, it doesn't mean that demand is awful. Demand is also increasing at the same time. So there's a little bit of a, derivative effect here, which, rate of change you're paying attention to. We are seeing people get back on airplanes. We are seeing motor gasoline demand begin to pick up with the normal seasonal effects. But the condition of demand is still tempered. One other thing that we've been paying attention to is the March 7 crude oil and other commodity import data that we got from China. Now, our view has been, given how much volume China brought in at low prices in 2020, it has some room to not be aggressive in importing at higher prices in 2021. And surely we see that effect in iron ore, copper, coal. For example, iron ore imports were down 6% in the January-February period on average relative to November. Copper was down 20%, and coal, interestingly enough, was down almost 40%. Now, part of that is tied to a little tussle with Australia, so there's some geopolitical dimension to that. But the number that really stood out was crude oil, 11.1 million barrels per day on average, January and February. That is higher than we expected. We did expect to see the kind of number we got at December, which was 9. To get back to 11 is more than 1 million barrels per day above trend. And it does seem that some of the media articles talking about the Chinese taking crude end product from Iran are probably true. And we've seen numbers as high as 850,000 barrels per day is the estimate for March. We'll give it the benefit of the doubt, but it does look like that as the Biden administration took their seats, the Iranian production was kicked up, and the Chinese are buying at a discount to Dubai and are getting a price better than what we're seeing on the screen.
Colin, what do you? I know we don't need geopolitical, conspiracy theories, but do you think the Chinese are just trying to give their friends, the Iranians, some money? Like, hey, I need a loan. I'll do some advanced purchasing here.
The Chinese are some of the world's best traders in this year and for the past 1,000 years. I think if somebody goes through a competitive market and gets a $5 discount, you don't need to think too hard about it. That was a great trade. And they may very well have 1 billion barrels of crude in inventory, but they're picking up at $5 below the screen. So
it kind of felt like the global oil pawn shop, and you swing by and say, hey, can I sell you some barrels? I'll take a little.
I think one takeaway from it would be that while we've been skeptical about demand in the very near term and have put some caution lights around the super cycle thesis, at least this is telling you the Chinese think there's going to be demand coming up later in 2021, and they may be right. So I would take that as a positive signal for people who really, really know the market well and saw good value on the table and took it.
All right, good. Well, Atul, again, thank you so much for joining us. We think the world of Dan and Jamie and you and your team, and the conference every year forever has been a joy. And it's also, I think all of us CERA watchers have been watching how each year changed a little bit. And somewhere in there, for instance, in my lifetime, I remember you started adding the shale players, and then you started adding the big tech companies, and then you've always done a good job of getting political and leaders and policymakers, and now you're getting more investors and financial leaders, and then of course the Agora technology initiative has really helped usher in the era of transition at CERA. And then this year it felt like you brought it all together in a digital powerhouse format. So what would you tell us as you reflect on CERA this year? How was it different? What was great? What was challenging? What were your big takeaways?
So, thank you again for having me, Maynard. I will give it, maybe 3-4 minutes of my initial thinking, and then maybe hopefully we have some Q&A and some discussion.
Yeah,
so
great.
I want it to be a monologue. So first thing to say is that, it was amazing. We had, by the end of the week, we had over 19,000 people who had registered. Not
Wow.
all 19,000 were there at one time, which could have been a little bit of a problem with the system crashing. But they were, it was amazing, highest for forever. And
Can you say what would have been your highest in-person attendance previously?
About 5,500 to 6,000, and that includes all the IHS market people and all the media, and and being in Houston, you get a lot of Houston participants and so on.
Yeah. Okay.
So it was 3 times that easily, and we're still getting people watching and listening every day. We're tracking, and we're going to track for 3 more months as to what will happen.
Oh, that's great.
That was
that's
really
great.
awesome. I think two things we're really worried about is getting the ducks lined up to do these panels. If you think live program is difficult, virtual is even more difficult, because you need to get 3 or 4 very busy people like yourself to all agree to a time to either record the panel or be there on live. And we had several pretty high profile panels live, which was always a high wire act, as we know. But that all worked out very well. I think the other thing to say is that we had the new map as kind of the theme with Dan's new book.
Yeah.
What kind of surprised me, and I've been in the industry for 30 plus years. I'm a crusty old petroleum engineer, so I'm a pretty skeptical guy, when it comes to big talk. I think what I heard, the one thing that I took away is that sort of energy transition is front and center, and the destination has been declared, but really nobody knows how they're going to get to that destination. I mean, it's kind of just everybody is winging it, if I can say that. But it's pretty amazing And I just picked up a few quotes which I'll read to you from various speakers. So Ben Van Beurden, who we know, Shell CEO, he said, net zero is both a moral imperative and an amazing business opportunity. I mean, that's pretty strong words, right, from Shell. Of all the people, Scott Kirby, who was actually paired with Ben, who is the CEO of United, he said this is the defining net zero as the defining issue for the generation to solve. And now he's an airline guy, okay? And one that is deeply personal to him. And he says it's the right thing to do, and it's the right thing to do for our children, our grandchildren. They will judge us on basis of how we solve this problem. I mean, that's again pretty strong word. Even Saudi Aramco, with the highest oil reserves in the world, their CTO Ahmed Koveter said the question is how to make oil and gas sustainable. I mean, I would have never heard this stuff, 3-4 years back, right?
I was struck by the quality of the people and the comments and the discussions and the unique panels, like you mentioned, having the Shell CEO with the United CEO. That was a really interesting, as they talked about things from each perspective. One quote I heard that I thought was fantastic is, "We're trying to eliminate emissions, not an industry."
Yes.
And that was, I thought, great. And I also was impressed that, some of the political and policy leaders that you had there was a real determination, I felt like, to be technologically agnostic. Like no one wanted to say they had the answer. No one wanted to say it has to be this way. People were being open to all kinds of, from carbon capture to nuclear. And I thought that was really refreshing because, usually the energy transition debate is not characterized, by that kind of openness.
Yeah.
And so
you're right about that, because I think the one thing we are getting a bit more educated and smarter as an industry. And I would say, when I say we, not just the oil and gas industry, but the overall energy industry, and we realize that it's not solar and wind is not going to cut it, because to really reduce emissions, you're going to need to do some heavy lifting in other sectors. The power sector has done a really good job, but there is transportation, there's industrial, there's residential. I think that sophistication is now starting to show up in people's comments, and in many of our panels. We had the same discussion. Many of my panels, because I was focusing more on technology, we started by saying, I would put the context to say, remember, carbon is the fabric of life. Carbon is good. It's the emissions we need to tackle. And that kind of, sometimes jolts people away, say, oh, really? Yeah, that's the problem, right? It's not about let's not, demean carbon. Let's worry about the emissions. And I think that sophistication is now coming in.
That audience, that 19,000 people, where they mostly come from, what were the most watched presentations? Is there anything you could tell us as you look at the data some more?
Our partners like yourself, their employees were the biggest audience, but even in those, the NOCs had more participation than IOCs. So a Petronas or ADNOC, Saudi Aramco, Indian Oil, Petrobras. So these companies, people, and I think one of the things we learned is that the time zone kind of played a little bit of a game, because for people in Asia, when we started, it was kind of end of their day, and they probably had their dinner, or they were having their evening, snack, and they were watching, and they will be there for like 4 or 5 hours. And we had this online chat thing with every session, which was amazingly popular, and people were putting out all kind of stuff. So it was great fun to be sitting there and watching what, real interest and real debate. So that was the big audience. We had a lot of financials, a lot of banks, many CEOs starting to show up. We had the Credit Suisse CEO, very senior person from HSBC and so on. So they also participated. And by the way, the other thing you mentioned is Amazon, Microsoft, you referred, they were in full force. And Microsoft, pretty amazing how much engagement they had. They think of our industry as a big target for them, as a growth opportunity.
It seems like Bill Gates, I know, was one of the lead speakers, and he it sets a nice tone for big picture. What are we trying to accomplish? And, lays out the challenge, but also lays out speaks candidly about, what are the issues. So that was a great choice to have him.
I think one other thing I should mention, since you were all talking about technology and Matt mentioned hydrogen, when I started the week and even before the week, I thought this was going to be, you may remember like 6-7 years back, we had one CERAWeek which was only about shale. It was shale on Monday and shale on Tuesday and shale on Friday. So this
what's
year,
wrong with that? I mean, we've done that for years.
I know. So this year when we started, I thought it was going to be all about hydrogen because it's so hot. And I always started my panel by saying, don't you think there is irrational exuberance about hydrogen? And that put people a little bit on defensive. But really what surprised me more than hydrogen was carbon capture. Everybody was talking about carbon. All the oil and gas CEOs, you had Darren Wood, Vicky Hollop, Sultan Jaber. They were all talking about carbon capture. Just unbelievable.
The thing about carbon capture that is so striking is you just, the math doesn't work. Just reducing what we're doing each year, you're going to have to start getting some negative emissions into this equation if we're really going to accomplish that, and that's obviously that technology.
On hydrogen, I think we're going to see a little bit of, I won't say fight, but competition between green and blue. I mean, there are pretty strong camps. So we have some European politicians and regulators. They have put all their money into green, and they say, oh, blue, yeah. But it's kind of like, I really don't want to touch it. If I can get the green done, then I won't have to worry about blue. So I think we're going to see, whereas the oil and gas companies in particular say, yeah, we can do blue, we can do carbon capture. So I think, and we have our gas, which we can convert into hydrogen. So we will see that kind of a tussle for a while to come. The other thing I learned is that there is a reason why direct air capture is gaining traction, even in some cases more than carbon capture. Because some companies, and I would put Oxy, you can't quote me, but I think Oxy would think in that direction, is that doing DAC is probably easier from a kind of regulatory, and putting all those pipelines and all the other stuff. So let's just do DAC and get that cost down, and it'll save me a lot of other money, which I have to deal with CCS. So I think we're going to also see this differentiation in strategy as to which companies go up. I mean, Exxon is the other one. They're putting in money in both of them, but we will start to see this kind of a focused approach.
No, maybe just one follow-on question to that. It's actually something that we try to address in the hydrogen report, which is back solving for a carbon credit that would make it economic over time and incentivize investment. It's something that we've been talking quite a bit about here. Colin brings it up with frequency, the trading of carbon credits in Europe, as well as potentially carbon taxes in areas like Canada that are becoming more topical. Just curious if that was topical during the conference, and kind of any broader thoughts on the carbon trading market in general. And that's just kind of a broader question for the group.
Yeah, Matt, in the conference, we had the CFTC, one of the CFTC commissioners, Benham, who said, we need a carbon tax in the US, he meant. So I think we're going to see something. My guess is that, there is this talk which John Kerry came in, and he gave a hint that they're convening this, which is now public, they're convening this big summit on 22nd of April, Earth Summit with multiple countries. A week before that summit, they're going to put out a new US target, more ambitious than the Biden plan. My feeling is that they're going to put out some framework around carbon pricing, not necessarily a tax, but something around that, which will help things like your point about hydrogen and other technologies. So one reason they want to be technology agnostic is because let technologies compete on the basis of cost and carbon, and then they will put the framework around it. I think it's very interesting to see what they do.
A super important point, because the tax, obviously, you want to keep as low as possible so you get the maximum buy-in. That was the great lesson of John D. Rockefeller in pricing gasoline in the first place. If you just crowd everybody out of the market, then you don't have the kind of scale to make it work. But if you realize that carbon in the atmosphere is truly a stranded asset that nobody lays claim to because they view it as a pollutant, then you have a zero acquisition cost. So you want to have the price of carbon be as high as possible, because somebody wants to capture that margin. And that, I would argue, is also part of the DAC, that if your costs are in the $200 to $600 per ton range, you're real excited to see the Biden administration talking about $100 plus as the received price.
Atul, you guys are to be congratulated, because I think what we're saying when you distill it down, and it's something we've been trying to do ourselves, a really intellectually honest, multiple opinion, lots to debate, lots to think through discussion of energy transition is fascinating and so enjoyable. And it's so nice when it's free from, catchphrases about, this, that, and the other. So you guys just did a wonderful job, and we were pleased to be a part of it. So I want to publicly just thank you for all the work you're doing.
Thank you very much. It was a great experience. We hope next year we'll be together in Houston, but my feeling is that the virtual part is not going to go away. We will do a hybrid, because it opens it up for so many people who would never pay $8,000 to show up in Houston, right?
We've had the same experience with some of our conferences, some of the biggest numbers we've ever had. But anyway, well, thank you, and please hang around, because we're about to do. Not quite, but we're going to do shale, and shale. But then we've got a mystery topic at the end. So Kirk, let me turn it over to you and welcome you, EJ and Erica. It's awesome having you guys with us.
Yeah, thanks, Maynard. Glad to be here. And so you have challenged us to talk about really the 5 biggest technical issues that we see and that we're discussing pretty much every day. I'm going to put those in really kind of 4 buckets, and I'll start with a hard hitter. And I really want to talk about cube development. So cube development, I think, is really the biggest technological challenge right now. We would refer to that as kind of full development of a DSU or of an area. Typically, when you have multiple stack pay zones, so the Permian Basin tends to be ground zero for this concept. And the questions include, what's the right order of operations? How do you actually execute in cube development? What are the results right now? We're starting to get public production results from some of the earlier cube data, but it's still pretty difficult to filter through the noise and understand, are we being successful or not? And the read-throughs and the implications are pretty serious. They're everything from operations to valuations to potentially even, how do you think about the macro supply and commodity mix. So I definitely want to start there. And what I want to do actually is share screen here. And I'm going to take a little detour, if I may, through GOR actually. Now, GOR is, a topic that we talked about, particularly in the Permian Basin, with great interest, 3-4 years ago, right? And so what I think happened then is we as an industry and really as a marketplace needed to kind of wrap our heads around reservoir engineering and this concept that as you drop the pressure in the reservoir, you're starting to see a little bit gassier mix than we anticipated originally. Well, GOR is back a little bit in the dialogue, and it's due to a combination of a couple of things. One is, as I said, we're getting a little bit more data from cube developments, and so we're trying to sort through what those data are telling us. And 2, frankly, the rise in social media. It's pretty easy now to kind of pull up public data and put a post out that says, draw some conclusions about GOR and cube development. And so we wanted to take a look at the data ourselves and see what we think the data are really telling us. So let's start with GOR first, and I'll show you a couple of maps here. This map right here is initial GOR for the Midland Basin, and this shows why we like the Midland Basin. It's very, very oily, very green on this map. The map just to its right, those late time GOR, 3rd to 4th year GOR for these wells, it's going to be pretty late in their lives. In terms of their high productivity. And what we're seeing here is more red. So we're starting to get that gassier mix. But right off the bat, you can tell that most of that gas is being produced in the southeastern part of the basin. And then the difference between the two is how fast your GOR, right? GOR is rising. So to us, that tells us a little bit what cube development is looking like. And, how are we changing the bubble point pressures, the reservoir pressures relative to bubble point pressure? And here, it's actually a pretty similar view. We're seeing higher gas in the southeastern part of the basin. So not a big surprise in terms of what we see in terms of GOR in the basin. Another way to look at this, though, is the plot in the lower left. Now, this is a plot of GOR by county, and the x-axis here is cumulative oil produced. So that's a little bit different. This is kind of a technical nuance, but we're used to thinking about GOR versus time, and GOR is going up versus time. What's interesting about GOR versus cum oil is that you can kind of look at the late life of the well and determine what those trends are telling us about where GOR is really going to end up. And here you do see this kind of bimodal distribution again. The red counties here are the gassier counties in the southeast, Erie and Reagan, Glasscock, et cetera. And here we do see that steep GOR ramp that you hear people concerned about. And a lot of the early cube development tests were initiated in where we started drilling horizontally in the basin in the southeastern part. So we have a lot of cube development tests in gassier parts of the basin. Interestingly, though, we've colored the kind of core counties where most of the activity is focused in the Midland Basin in the greens because of the oilier parts of the basin. And so that's going to be your Howard, Martin, Midland, and Upton counties in green. And here we see a pretty modest GOR ramp. We recognize that GORs are going up a little bit, but the scale here is showing us that at the end of life for these wells, we're looking at a 2 to 8,000 cubic feet per barrel type GOR. So nothing too alarming here. Really, for us, the GOR is really a function of just where you are in the basin. The southeastern part of the basin is higher thermal maturity. The other part of the narrative that's kind of out there, though, about GOR and cube development, and the reason that I'm talking about GOR is that the narrative out there in some circles is that higher GOR is leading to lower oil production. The GOR by itself, a little bit more gas, it doesn't seem like a big deal, and gas is worth a lot more than it has been over the last couple of years. But if there's faster oil declines due to cube development, then that is a problem. And so we wanted to explore that next. Now, this is a pretty dense slide. I'll spare you the details and really just kind of give you the high-level observations. But as we start to look at oil production as a result of cube development, you have to do a few things first to get the baseline data, which is actually pretty complicated. And this is why talking about the performance of cube development is pretty difficult. So, for example, one of the things that you have to do to understand the performance of a cube or a DSU, when I say DSU, I mean drilling and spacing unit, we actually had to draw every single DSU in the Permian Basin. So things like that to be able to get the baseline data so we can actually say, here's a DSU, how is it performing? So once you do that, one of the things that we've really recognized is that on the one hand, you can talk about cube performance. On the other hand, though, you have to talk about the context of that cube. What's the history of development of that cube? What's the order of operations? Was one bench drilled up? What was the spacing like? Were the completions optimized? Things like that. But let's start with the first part, cube performance. So if you just throw everything on a graph, that's going to be the plot in the upper left. And what we're looking at here is on the y-axis, this is DSU EUR. And on the x-axis, this is the number of wells in that DSU. So you would expect to be able to add wells on the x-axis and increase EUR linearly, roughly. When you throw everything onto one plot, though, you don't really see that. You see this kind of rollover here in the EUR versus wells plot. And so some have taken this to say, well, there's just a point of diminishing returns, and you just can't drill as many wells as we thought in a given cube due to this effect. However, based on what we saw on the previous slide, the first point that I would make is that a lot of these early cubes and a lot of the cube data period are in the gassier parts of the play that are exhibiting higher GORs and lower oil production anyway with time. And so what we did here is to color the gassier counties light blue versus the oilier counties in dark blue. And you can see that rollover is exhibited mostly in those gassier counties, whereas the darker blue oilier counties are kind of following this more linear trend. So first of all, we recognize that we need to subdivide a little bit more based on geography and based on geology. And so we'll separate out the oily counties and we'll actually subdivide even further. And let's just look at Midland County. So core of the core in the basin, where actually most of the cube development tests have been actually drilled in the basin so far. So what we tend to call a real cube development is greater than 20 wells per DSU. So that's going to be this line here and to the right. So we're going to focus in on these kind of true cube developments. And interestingly here, you still see a little bit of spread here in the results. Some of these wells are following the trend that we saw with less dense development, and some are falling below. And here's the part of the equation where we have to look at now what's the context of that cube development. So what we actually did is took every one of these DSUs and peeled them apart, figured out what were these landing zones exactly, how many visits did the operator make to the DSU, what were the fracs that were put on them, what was the spacing in each zone, and so on, really tearing apart every variable that you could analyze in each one of these cube developments. And so basically we came up with a series of pass-fail checks then. So it's things like, were there a lot of visits paid to this DSU so that there was a lot of depletion before an adjacent well was drilled? In some cases, you've seen operators drill up just one zone, let's say the lower Sprayberry, and then tried to come in a year or two or three later and drill the Wolfcamp A adjacent to that. Those cubes tended to underperform. Another common scenario is older completions, especially for the older wells in the DSU. That's obviously going to drag down your overall average. And what we found is that the DSUs, the cubes that passed every one of these tests are colored in green here, and they tend to follow this linear trend that we saw from less dense developments. Those that failed any of those checks are colored in red here, and those are the ones that underperform. And so rather than seeing this rollover, we really isolate the cube developments where operations kind of followed best practices as we understand them now, that were optimized in terms of the timing, the spacing, geology, landing zone, and everything else that you can possibly think of. And there's a lot of those, but there's also a lot that underperformed. But this gives us hope that fundamentally in the subsurface, what we're seeing is that, again, that right order of operations should lead to continued success here. Let's show you what this actually looks like. So I'm going to show you this one data point here. So that's one DSU that happens to be drilled at 26 wells per DSU. And so we're sitting here in northwestern Midland County. Core Midland Basin. This is a 26 well cube test. All the zones have been drilled here from the Middle Sprayberry all the way down to the Wolfcamp B. And it's an outstanding performer. And so when you look at the history of development in this DSU, it's remarkably unremarkable. This is kind of how we thought that development would look in these stacked pay basins. And so you can see that the operator took 8 visits to fully develop this DSU. That sounds about right. Really in kind of 4 phases as we see it, but an initial tranche of Lower Sprayberry and Wolfcamp B wells. They added in Middle Sprayberry and Wolfcamp A, and then they continued to flesh out the DSU. But they never marched across and drilled up an entire zone. They really did a good job in kind of spacing out these zones, and they put modern fracs on these wells. And again, it's an outstanding performer. There are many more examples like this. But I guess I should again kind of contrast this with what we've seen that I think we've kind of learned what not to do, and that is coming in and drilling up one zone, because those adjacent zones are going to see the effects of depletion from that one zone. And if that one zone is drilled at really, really tight spacing as well, we've seen the Lower Sprayberry drilled at 20 wells per section in some cases. That might actually be successful in the Lower Sprayberry, but those later Wolfcamp A wells are going to underperform. Yeah,
can I try to ask a question on behalf of our audience? So your premise in looking at all these cube developments is the notion that gas-oil ratio may be getting worse faster in cube developments, and related to that, oil production may be getting worse faster in these cube developments. But your punchline, I think, is if it follows the pattern that you're laying out, which is sort of the way you would hope it would be done, then those observations are not the case. Is that a fair summary of what you've just gone through?
Exactly. That's right. So, on the one hand, if we're seeing gas-oil ratios rising slightly, and then we see this oil trend that on average, if you didn't know the difference between the greens and the reds, you'd say oil production is dropping as well. You tie those two things together and you say there's a problem here. Our analysis is showing that is not the case.
Interesting. And how many, you mentioned this before, I think, how many cube developments have we had across the Permian in the last couple of years?
I would say that this cloud here, and it's almost a shotgun blast, right? That's tighter than 20 wells equivalent per mile wide DSU. It's probably on the order of 50 cubes. So it's still pretty sparse in terms of data. It spans several decades, and not decades, but several years and several vintages of completions. So we've learned a lot since we drilled the first wells that are parts of these cubes. The punchline is that we're encouraged by this green trend. We've seen what industry has done in terms of getting up the learning curve and drilling parent-child wells or single zone tight spacing wells. We'll talk about that in a little bit as well. Our upshot here is that we're encouraged by this, and we think that industry is and will continue to pick up on this and optimize even further, so that we should be on trend, maybe even above trend, like this pad that we just talked about.
Okay, awesome.
So that actually dovetails nicely with our second technical topic, which I kind of would paraphrase to say that how can we, as an industry and our team in particular, how can we be smarter? How can we be more efficient? And how can we, kind of leverage the tons and tons of data that we have here? And for us, this cube development analysis actually is a pretty good example, because when we started looking into this, we realized that, in contrast to single zone analysis, where you're looking at maybe interwell spacing and EUR and geology, with cube development, you've got almost a a staggering number of variables, almost too many to really comprehend. And so for us, the real kind of light bulb that went off was the ability to use data analytics and machine learning to be able to sort through, figure out the relative importance of really a ton of variables, anything from geology to completions to geometric spacing to timing. And so I wanted to introduce Erica Powell, who's a director on the team. She has master's degrees in both geology and data analytics, and she really helped us to sort through this. And I do think the bigger picture here is that, you know, in a risk-off, cost-conscious kind of environment that we're in, the applications of machine learning is a really cost-effective way to get to answers without having to drill wells. And again, we've got tens of thousands of horizontal wells now that we should be able to leverage to make smarter decisions and optimize economics in our operations. So Erica's going to share a little bit of the background of that technology.
Thanks, Kirk. So yeah, you know, like Kirk mentioned, data analytics and multivariate modeling, it's a big data tool that's really useful for us to answer just complex multivariate problems where we have a lot of data, a lot of variables, and problems like that benefit from having a sophisticated kind of machine learning type model. And so oil recovery is a really good example of that, where there's these complex interactions between geology, completions, cube development, all impacting how a given well is going to perform. And so a random forest model is a really good example of a machine learning algorithm that is beneficial in helping to understand those types of interactions. And really that model is useful for two main reasons. One, it lets us be predictive. So when we're trying to understand how much oil we're going to recover, we can predict that using this type of model. And then secondly, it helps us to understand the relative importance of the variables that are impacting production. So it really helps us to unravel, make observations on well performance that's really difficult to do with this kind of 30 plus columns of data. And so that's the power behind this model. And so one example of using this tool is trying to predict oil recoveries in the Midland Basin for a given well. And so we're incorporating all of these variables. So a few observations when we look at a model like this. The first is that we can predict EUR really well. And so that's what's shown in the bottom right of the slide that's on the screen now. So we can explain about 88% of the EUR variability in the Midland Basin. So it's a good model, and it really highlights the predictive power behind this type of technique.
Erica, it's been a long time since my grad school stats, but I remember R squared's at 0.88. That's pretty darn good.
It's pretty good. Yes, we're pretty happy with this. So essentially that's saying, you know, we're explaining 88% of the EUR variability in the Midland Basin. And the model's able to do that with a lot of the complex variables that Kirk talked through. So it's a good model, definitely powerful on the predictive side. And then as you also go through some of these models and make more of them, you start to see consistent themes pop up. And so one thing that we've seen consistently is that geology, rock quality, and completions tend to be some of the most significant variables that are impacting production. And that's really intuitive. So we kind of understand that just from an intuition perspective, but the model's actually quantifying that for us. So again, that's one of the benefits there. And then the other observation when looking at a model like this is we're looking at every well in the Midland Basin from the Middle Sprayberry down to the Wolfcamp B. We're seeing that how the DSU is developed is really impactful for how a well is going to produce from a Q perspective. So we're seeing things like TVD separation between wells, the development timing, how the DSU is composed. Those are all impacting well performance. And so really we can see that when we optimize some of these variables, both from a case study perspective, like what Kirk discussed, and then from a big data perspective, like we're showing here, we can achieve these high oil recoveries that are on par with single zone development like we've seen in that Kirk just walked through.
How many wells are you have in these data sets? Like, right, it's a stunning amount now that we've accumulated.
It is, yeah. So this is thousands of wells, in the thousands. I think the exact numbers in the kind of 4,000 to 5,000 range or more. So it's a lot of data, and that really drives the power behind this type of model. When we have this type of this large amount of data, we can really deduce some interesting observations there.
Well, thank you, Erica. We're darn lucky you joined us a few years ago. So keep up the great work. We're going to have to get that random forest working on some other predictive things. So we'll have to circle back. That could be a whole nother show. Kirk, what's next? We're on to 3, 4, and 5, and I know number 5 is a surprise. We got to get that in the next 10 minutes here.
Sure, sounds good. Buckets 3 and 4 are actually going to be lumped together, and that's really generally talking about the topic of inventory, in particular Tier 1 inventory. Now, we've been talking about the Permian Basin and cube development, which obviously impacts Tier 1 inventory as well, but there are interesting kind of operator industry responses to more shrinking inventory in other basins that are a little bit more mature. And it's interesting to compare and contrast. So in the Williston Basin, we've seen Enerplus expanding their position, NCAP entering the basin with Grayson Mill. So there's some interesting trends in the Bakken and in the Three Forks as well. And secondly, I think the trends in South Texas are particularly interesting in the Eagle Ford and the Austin Chalk. We've heard EOG and SM Energy talking about not just the Eagle Ford, but again, the Austin Chalk. And again, trying to expand the amount of Tier 1 inventory that we have in each of these really core basins. So to do that, I'm going to have EJ Snickeris talk about that, executive director on the team and longtime technical professional. And so take it away, EJ.
EJ, we're really lucky to have you too. And you kind of look like you've been sneaking into San Francisco, taking their CO2 during COVID. You got that look,
Wow, you found out the secret to this long beard. It's carbon capture. But yeah, no, this inventory and core inventory is a really key theme. And, some of the best ways to observe the ever-changing landscape of core inventory is through the more mature basins. And as Kirk mentioned, the Williston and South Texas in particular are a couple great examples. And so, when you start to look at the development histories, we'll start with the Williston. The Williston is a long run basin. It has been from the beginning, and it continues to be a poster child for completions evolution, but also development evolution. And so what we're looking at here is the evolution of the basin from a parent, child, and co-developed lens. And so what you'll see with the dark blue bars all the way through 2012 is the basin was primarily developed using what we're calling parent wells, single wells, one-offs, opposite sides of the DSU, really figuring out what's going on. As you move into the more modern periods of time, 2013 and beyond, you'll see not only has that child, the gray bars, increased, but you'll also see that co-development really ramped up in the lighter blue bars. And so the parent development moved to that true development. Now it's less clear and a lot more complicated in the Williston when you talk about a span this long, from 2001 all the way through 2019 on this chart, on what is the implications of that. And so you're seeing multiple generations of completion, multiple generations of technology, and also multiple theses of development at play. And so what you're seeing in the past few years is actually that concept has really solidified into what is the go forward metric, leaning into things like plug and perf development, a stable completion size of roughly 1,000 pounds a foot, and then also really dialing in on what is the appropriate well spacing and ways to dive into that. But if we look at really the next set of images, it has kind of a spatial component to what is the future evolution of the basin and what does that mean for inventory. And so what we're showing here on the left side is for the Bakken, on the right side is for the Three Forks. And this is taking the parent-child co-development concept and then marrying it with where you have inventory, and then taking a look at the bottom of the page to see what are the implied economics there. And so where you have the most red, that's going to show the areas that are most developed, and the remaining inventory there is likely to experience some sort of parent-child relationship that would further suppress volumes and potentially impact your break-evens that you can see on the bottom. But a really exciting concept that has started to kind of move, and this is where we're going to get into what is core versus what can look like core inventory, is how do you turn the areas that are outside of the traditional core into something that can compete for capital and returns. And so what we've highlighted here is that area 13 on the left map is a great case study example. And we've also boxed that break even there in blue, which is about $55 a barrel for the Bakken. The key thing there is If you look at the equivalent area on the right, you'll notice very little Three Forks development. The economics associated with those Three Forks areas are actually relatively challenged compared to the core areas. So is there a way to turn these, we'll call them core adjacent areas, into something that is core-like inventory quality? You can see what the implication is on the potential economic uplift. So in this specific area, we're seeing operators moving to a Bakken-only style development. So there is hydrocarbon in the Three Forks, but what you're actually seeing is operators are willing to target only the Bakken and really focus on those single well results for actual development in the Bakken, while foregoing that Three Forks landing. And it's less of focusing on trying to increase true inventory, but turn inventory into competition for what is down there in the core. And so if you follow the blue arrows there, you can see in the top set of type curve areas where that specific area would fall. Once again, $55 a barrel break even. But then you move into what happens if you remove the Three Forks from that type of cube development interaction, if you will. And what does that look like from the uplift we're seeing in the area? So if you're looking at a more dense Bakken-only development while removing the Three Forks in an effort to maintain a little bit more inventory there, you're seeing a moderate improvement of about $4 a break even. So that moves you farther up into the evolution of trying to reach that core-like inventory. But what you see in the dark blue is that these are the results we're seeing from operators that are starting to focus on that wider Bakken spacing while also dropping the Three Forks. And now you're seeing a trend that's actually moving into the direction of competing for that core type economics. And there on the chart there, it's about $39 a break even. I would like to stress at this point, more data is needed to further confirm really the evolution into the dark blue realm, but the early indications are very exciting.
So EJ, is the punchline of what you just said, this stuff that's quote non-core, if we upspace and if we don't go for the Three Forks, just go for the Bakken, you know, you could have wells that compete with the core, but at the same time, you're going to chew through your non-core inventory quicker, are you not?
Yeah, that's exactly right. So you'll have a set of inventory that would really compete at detailed level, but also you will end up moving through that quicker as a result of that increase.
Well, Kirk, I know, EJ, that was fantastic. Thank you. And the joke about CO2 capture in your beard is one of the best of the year. That was fantastic. Kirk, I know we're kind of getting short on time, and we're coming up on number 5, which is the big surprise. Maybe not total shocker, but it's the hidden nugget of today.
That's right. Yeah, the last bucket here that we're really focused on is the new energy bucket, and one sort of application of or source of renewable energy that really is particularly intriguing right now, and kind of came to light, especially during the winter storms in Texas last month, is that we could use a little more diversity in terms of both traditional as well as new energy, and intermittency is a big issue. And so for us, that technology is actually geothermal. We don't hear a whole lot about geothermal. I think the technology is still pretty frontier these days. But I wanted to walk you through our views on the technology, because this really isn't what I call, this isn't your father's geothermal. We're moving away from volcanoes. We're moving away from hotspots. And the reason that we've been able to do that is because of advancements in the technology. So I'll just show a couple of images here. And so what we're looking at here is a map of, sort of hotspots in the US. But again, we're moving away from really high temperatures to enough to boil water, essentially, in the reservoir. And, I'm also struck by the fact that there's the ability for homegrown geothermal energy in both Texas, in the Eagle Ford and the Haynesville trends, as well as Colorado and the DJ, in association with the Front Range and Colorado mineral belts. So it's pretty interesting that these sources, potentially sources of geothermal energy, are really right here at home. The technology really works here, and it hasn't really changed a whole lot. in the past several decades is that we're essentially pumping cool water into a formation that's at a high temperature. That water gets heated up, and in what we call an open loop geothermal system, we pump that hot water and steam back to the surface to turn turbines to produce electricity. There's a couple of interesting observations in addition to the existing oil and gas fields, is that there's a lot of overlap with the oil and gas industry in particular. So, we should be sort of natural allies with this source of new energy and natural experts, because we're talking about drilling wells potentially and occasionally hydraulically fracture stimulating those wells to increase the production of that hot water and steam. So there should be a natural and happy marriage here. And what we're seeing in the marketplace is really that. We're seeing oil and gas companies participating in and investing in some of these geothermal companies. Greenfire Energy is one example. Shell has invested in Greenfire's project in California. Evor is another that this year BP and Chevron invested in as well. These are closed loop companies, and it's just an interesting twist on the technology, which is pumping down hot water. You can think about it using an old well bore, for example, pumping down cool water and then letting the formation heat it up, and then maybe pumping it back up the annulus or vice versa up the tubing. And so a lot of industry is really paying attention to this, and I think that it's a really exciting marriage between the two expertise in both new energy and kind of traditional energy. We do view this as an exciting and potentially viable source of homegrown, non-intermittent renewable energy. And it's one that just has obvious synergies to the oil and gas industry as well. So really exciting new technology in the new energy space.
Well, look, that's fantastic. When you said, Kirk, a natural and happy marriage, that just sounded like such a great thing. But you're right. It's what we do, and it's what we know how to do, and so it's a great way to end. We've gone long today because we had so much great data and information and that perspective from a tool. So, Kirk, cannot thank you enough. Erica, I want to use Random Forest for a whole bunch of other stuff. You gotta help us. And EJ, you're always a joy, and that was fantastic work. So, Colin, Matt, Mike, everybody out there, enjoy spring break. Thanks for all you do, and keep up the good work.